All right, David, welcome to the show.
Good to see you.
Good to see you as well. Good to have you on this side of the studio.
That's right. I get to sit down today.
Yeah, there's a lot to talk about, but let's start with that video because everybody's asking about bonds. You've mentioned on your radio show and mine that there's a risk in bonds right now. Everybody wants to know about interest rates, real estate. So you tell me. One
thing that's unique is actually you bring up a great question, and you talked about short-term versus long-term. And what's happened is that people don't realize short-term interest rates, 2-year interest rates have actually gone up 300% in the last 3 years, which is unbelievable. They've gone from a low of like 0.16. We're talking about really short-term interest rates, but all the way up to 0.55. Now that's about 300%. What that means is I reviewed a client's portfolio the other day, and most advisors are putting people into short-term bonds because they think there's more risk in long-term bonds. Well, I've seen clients losing money the last couple of years in short-term bonds. So there is a flattening, what's called the yield curve, meaning as short-term rates rise, long-term rates fall. You know, you got to be careful because you can have what's called an inverted curve where short-term rates are actually higher than long-term rates, and that's called recession. Now, it doesn't look like we're anywhere near that, but you got to be careful with bonds. Bonds are not my favorite. I think you're not going to, even if bonds don't go up, don't exceedingly rise, you're not getting a real rate of return. And for about every 1% increase in interest rates, you're going to lose on a 10-year bond about 8% of your portfolio. So I know it's kind of a long-winded answer, but it's a problem for most consumers and investors because they don't really understand it.
Yep.
And if I always say if I could teach one class, Craig, in finance, it would be on bonds.
Interesting. You know, and there's a lot of questions right now about bonds, about bond bubbles. You're in things like inflation, where we have short-term interest rates at 0.25%. You've heard of things like the Fed printing money. So these are all risky things, but I think one of the most important things for people to look at right now is the market's hitting all-time highs, which is great, right? We want the market to go up. But how many months in now on a correction are we?
We're about 35 months.
So about 35 months into correction. The average 10% correction is 18 months, so almost double what we would normally see. So that puts people at risk here. One of the things that you're doing is you're offering a second review for anybody who wants to check it out and make sure that they're in good shape and they're not at risk of that. But you provided me evidence this week for the radio show. We have it here today, actually illustrating the potential correction. So let's take a look and help us understand what's going on.
Yeah, so this is what Robert Shiller, who's actually a Yale professor. He won the Nobel Prize in 2013 in
Big
economics.
real estate guy.
Yeah, the Case-Shiller Index, you've probably heard of. It's the top 20 cities that I'm sure you're familiar with, Craig.
Yep.
And the rest of the audience basically giving what the valuations or increases or decreases in the top 20 markets. Well, he also does a lot of economic price earnings ratios or valuations. And what this chart here is showing you in English is basically only 4 times in history, including today, you've had that we've had higher prices or overvaluations in his words. 1929, the stock market crash. 2000, the tech bubble. 2007, the financial crisis, and right now today, 2014. So I've already told you that we're overdue for a correction by at least 18 months, a 10% correction. It's been almost 36 months since we've had a 10% correction, which is healthy for the market. We're in midterm election cycles, which I talk about all the time. Generally have about a 17% reduction or correction in the market. There's lots of headwinds right now. Rising interest rates, potentially. The Fed pulling away, tapering. So it's just a difficult time, and I just really urge you to reevaluate where you're at. Make sure you understand what you have and that you have some real risk management to your portfolio. And unfortunately, most of you don't, and that's a problem.
And what do you do, run to cash? I mean, like, what kind of, how do you advise somebody in this type of situation? I know it depends on your goals and the age group, but in a market, we don't want to bring out a crystal ball and say this is what the market's going to do. We're just stating the obvious that it is probably due for a correction. So let's just make an assumption that it will correct. If you were going to make strategic moves now to brace for a correction, is there anything that you would advise into doing?
Yeah, I mean, quite frankly, the closer you are to retirement, the more careful you want to be with stocks and bonds. To give you an example, a typical portfolio, Craig, is 60% stock, 40% bonds. In 2008, that portfolio that people felt confident about lost 30%. Okay? Is that risk management? No. Okay? So the closer you are to retirement, our average age of our client is about 67. Most of our clients are either in retirement or near retirement. But so it's more important for those people that are in that situation to look at a couple things. How do we actually, there's ways, Craig, just like you buy, I always say, homeowners insurance for your home, auto insurance for your car, there's actually ways to protect downside risk against equity portfolios, and we use those to basically reduce the volatility down to about 5 to 7% maximum drawdowns in a portfolio.
Yep.
So things we use, you've seen them, I've showed them to you.
You've done them for a friend of mine recently.
Yeah, exactly. So there's real ways to manage risk. And so I would just urge you to reevaluate, make sure that you are prepared for a stock market, correction, hopefully not crash, but correction, and also that you really take a look at your bonds. One of the replacements, I'll give you another piece of advice that I use to replace bonds are, quite frankly, annuities. Because you can get a fixed return if you're retired of 5% distribution rates. You don't have interest rate risk. You don't have inflation risk, and it's an income stream that you can count on. And these are for near retirees. I'm not talking for somebody.
Everything's case by case.
Yeah,
right?
everything's case by case, but it's a great proxy for bonds because you're going to get the benefit of the distribution of income without all the risk. Because typically these come with guarantees of principal, which are based upon the claims paying ability of the insurance company. That's my disclosure.
Yeah.
But the point is that it's complicated. I'm saying a lot of things that some people are getting, some people are not. I will tell you, 99% of the people I sit across from do not have proper risk management in their portfolio.
Well, even if you don't understand it, I think it's obvious that given where the market is and a lot of the X factors that could turn it, being prepared for correction, getting a review is a smart thing to do. I mean,
for sure,
a correction is obviously something that could be right there. On your radio show, you've talked a lot about President Obama, some of the policies coming in. You've talked about the budget. On my radio show, we were commenting on how it really doesn't necessarily matter if the market goes up or down. If you can minimize the amount you're paying in taxes, right? That's going to help you in any marketplace. So a lot of the reviews that you've been doing for our radio listeners as well as the TV audience has to do simply with making sure you don't have more going out the door than you need to by a proper structure on your taxes. So speak to that if you could.
Yeah, I'll give you an example. One of your radio show listeners who I'm doing a review for right now, he was surprised. He was making over $170,000 a year, and he got penalized for Medicare. So he had a tax on Medicare that he was unaware of, called me about it, and said, David, can you help me to mitigate this? And this was on tax-free bonds, and he didn't realize that tax-free bonds actually counted towards the income. So you're absolutely right, Craig. There's many different ways that you can help to mitigate taxes and save people money. One of the things I was talking about on my radio show last week was that Obama, in his 250-page budget, kind of slipped in, as you and I talked about earlier, Craig.
They're good at that.
They're good at that.
Yeah.
It's literally like 3 lines, and President Obama is trying to reduce your Social Security benefits. There are certain strategies that are used that can help you to increase, that we use for our clients, your benefits that you paid for. And Mr. Obama has legislation that he'd like to pass that would actually take away benefits for everyone. And I don't have time to get into it in this show, but it's very, very important. In fact, we're hosting workshops that we talk about. I do Social Security workshops for clients because they're it's very complicated, Social Security. So we're doing one this month. If you want information on it, you can go to our website at reyesplan.com, and Craig can speak about that. But we're doing 2 this month, and we do them basically about 8 times a year. If you go to the events page on there, you can go and register. They're always fully attended, and they're awesome. I love doing them because most people have no clue about Social Security. I didn't a couple years ago, and I became an expert at it. It took me a while. I was trained by an ex-Social Security actuary. That's fun, and a CPA. So that was
sounds like a fun.
Oh yeah, I was going to invite you. Yeah, exactly. So the point is that Obama, what you're talking about is so true because we want to mitigate taxes and we want to maximize benefits that you've already paid into.
Yeah.
So if I was helping you, I want to maximize your Social Security. I want to mitigate your taxes, and so unfortunately, President Obama is choosing to, for whatever reason, a little divisiveness, thinking that these strategies are only used for the rich, whatever that's considered now. So I'm significantly opposed to what he's proposing.
Well, people can hear more about your opinion on your radio show.
Yes,
it's Sunday mornings on KFMB. David Reyes is heard on my radio show as well, which is on 1170 AM KCBQ at 6 p.m. on weeknights. Look, there's a lot of risk out there. There's also a lot of opportunity. That's kind of the country that we live in. What we got to do is we got to mitigate the risk and exploit the opportunities. Right now, with the market hitting an all-time high, due for a correction, hearing things like inflation, hearing things like bond bubble, hearing things like QE3 going away, it really does make sense to get a review. Why? Well, just make sure you're not exposed. If people with Enron years ago would have gotten a review, or people holding a lot of real estate in 2007 would have got a review, it might have saved them and even our economy for that matter. So I encourage you to do that. David Reyes will do this for you. These things can be very expensive out in the marketplace. As a viewer of this show today, he will do it for you for free. But you do have to email him today to get in. He can't do it for everybody. So the first 5 people to reach out, go to reyesplan.com. He's going to waive any cost to do it. It's free advice. You can also see that David is now author of a book, and you can pick up his book there as well, reyesplan.com, and the seminar that he's going to be doing here coming up soon. So reyesplan.com, connect with him there. Thank you, David Reyes.